You've probably heard this term thrown around on the news, right? Quantitative easing, or QE. It sounds super complicated, maybe even a little intimidating. But honestly, it's one of the most powerful emergency tools in the entire financial world. And today, we're going to break it all down. Simple as that.
So let's set the scene. Imagine the economy is in a nosedive. The first thing a central bank usually does is cut interest rates. That makes borrowing money cheaper, which gets people and businesses spending again. But what happens when interest rates are already basically at zero? What do you do when your main tool is already maxed out?
Well, that's exactly when the government pulls out the big guns. When the standard playbook just isn't working anymore, they turn to this powerful and pretty unconventional solution: quantitative easing.
So what is it really? At its core, QE is when a country's central bank, like the Federal Reserve here in the US, basically creates new money out of thin air. It's all digital. Then it uses that new money to buy things like government bonds from big commercial banks. The whole point is to pump cash directly into the financial system. Probably the best way to think about it is this. QE is like a shot of espresso for a really sluggish, tired economy. It's this huge jolt of energy designed to wake everything up and get the system moving again. Okay, so we've got the what and the why, but how does just creating digital money and buying bonds actually help the real economy? Let's walk through exactly how it works, step by step. It's really like a chain reaction. First, boom, the central bank creates new money. Second, it uses that money to buy bonds from commercial banks. Now, all of a sudden, those banks are sitting on huge piles of cash. And the theory is, with all that extra money on hand, they'll be way more encouraged to lend it out to people and businesses, which, you guessed it, boosts spending and investment across the entire economy.
And look, this isn't just some dusty theory from an economics textbook. QE has been a major player on the world stage in our lifetimes. So let's look at where we've actually seen it in action.
Yup. Think about two of the biggest crises of the 21st century. QE was the go-to response to the huge recession after the 2008 financial crisis. And then it was rolled out on an even bigger scale in 2020 to keep the economy afloat during the COVID-19 pandemic.
And the amount of money we're talking about is just mind-blowing. It's not millions, it's not even billions. The U.S. Federal Reserve bought trillions of dollars worth of assets. It was a massive effort to stop the whole financial system from collapsing.
So why should you care about all these trillions? Well, it actually has a pretty direct impact on your wallet. A huge result of all this bond buying is that it pushes down long-term interest rates. And that means cheaper mortgages if you're buying a home, more affordable car loans, just lower borrowing costs for pretty much everyone.
But just like any really strong medicine, QE definitely comes with some serious potential side effects. It is absolutely not a perfect solution, and there are some very real risks that everyone has to keep a close eye on.
There are three main worries here. First, inflation. Pumping that much money into the system can cause prices to rise way too fast. Second, you've got asset bubbles. All that cheap money can make things like the stock market or housing prices shoot up to unsustainable, dangerous levels. And finally, the central bank is left holding all these assets, which can be really complicated to deal with down the road.
All right, we have covered a ton of ground here, from the basics of creating money to the risks of inflation. So let's just do a quick final recap of the most important things to remember.
Think of this as your QE cheat sheet. What is it? Simple. A central bank buys bonds to give the economy a boost. Why do they do it? Because the economy is hurting and interest rates can't go any lower. How does it work? It adds money into the system to get banks lending again. And the big risk? It could spark inflation or create those dangerous asset bubbles. If you just remember those four things, you've got it.
So, at the end of the day, it all comes down to this big question. Is QE a necessary cure that saves us from economic disaster, or is it a risky addiction that we'll have to pay for later? Honestly, the debate is still raging, but now you have a much better idea of what they're all arguing about. Thanks for tuning in.